Good afternoon, and thank you for joining us today. My name is David Talbot. I'm Managing Director and Head of Research here at Red Cloud Securities, and I'm delighted to host a Red Cloud webinar on uranium today. We will hear from Global Atomic Management, including Steve Roman, Chairman, President, and CEO, and Bob Tate, VP of IR. During today's webinar, they will provide an overview and outlook of the company. We will then take some questions. You can type the questions into the chat box at any time, and we will get to as many as we can. But before we kick things off, first we need to discuss the fine print. During this webinar, forward-looking statements may be made. I would direct listeners to the company's forward-looking statements outlined on page 2 of the Global Atomic Corporate presentation. That can be found on the company's website, globalatomic.com. For Red Cloud Securities, Inc., I'd highlight this webinar is for informational purposes only. It should be not considered for a solicitation or recommendation to buy or sell securities. We note this call does not consider the particular situation or needs of individual investors, and participants should rely on their own investigation and seek their own professional advice before investing. Please see our most recent research located on the Red Cloud website for specific disclosures on Global Atomic. Now, before we get into it, first a couple of words on uranium. Now, spot prices are up a couple of bucks this year. In my opinion, this is partially mine supply driven, partially physical demand driven. We still await an increase in long-term contracting to support uranium prices on a sustainable basis. But we do believe the current fundamentals are as strong right now as at any time over the past couple of decades. I believe the nuclear industry is in great shape. There are 443 reactors in operation. This is in line with 10 years ago. There's a total of 54 reactors under construction. Uranium demand continues to rise. Government support is increasing, particularly in the US, China, and Russia. And China is on track to become the largest nuclear power producer. Uranium is gaining recognition as a green energy source, and its supply has been falling. There have been significant mine curtailments, and COVID-19 impact was severe, with a decade of low prices. We have not seen the investment necessary to sustain production levels, and that's where I think the Global Atomic comes in. So with that, I now turn it over to Stephen to update our company, our audience on the company.
Thank you, David. It's a pleasure to be here at the Red Cloud event, and we really appreciate you hosting this for Global Atomic. So ladies and gentlemen, we'll move through here with a PowerPoint presentation. This is a typical disclaimer I think everybody's familiar with, so I won't dwell on this. And we'll move through a little bit about the company. So Global Atomic is a unique business since we have two divisions. One is a cash flowing operating zinc division, base metals division. The other is our uranium division that has 4 deposits currently in Niger. And we will be focusing on the large DASA project that we are currently just completing a feasibility study. So the zinc has added a component of cash flow to us that has allowed us to really move the project, the DASA project, through to its current level. And akin to what David just mentioned about 10 years of really stagnant uranium prices, it's allowed us to develop our project without dilution to our shares in any large measure. So we are in Niger, and that's really one of the top producing areas in the world. And of course, we're in an area where there is long-term production, being the French mines Cominac and Sommer. And we are blessed with excellent infrastructure. And in 2010, we found the DASA deposit and really focused on that as a standalone, high-grade, high-margin underground operation. This is a longitudinal section of the DASA deposit as it sits currently. You will see mine workings throughout all the different various levels of the deposit. And this is basically a plan that was put together with a 2018 preliminary economic assessment that we did that envisioned some open pit, underground, and a full-scale development of the entire project. Now, because of uranium prices moving up somewhat, but really remaining at a fairly low price from historical levels, we decided to focus on an area we call the flank zone. So the flank zone you see there with the green box around it, and we view this as a phase one development. It's about 20% of the overall deposit. And so that's what we are currently completing our feasibility study on. So the plan is to do this as an initial mine, 12 years, very good grades. And then as we are mining there, we will develop the rest of the deposit. We'll talk about that a little bit as we go along. This is a grade tonnage report on various cutoff grades that we have at the Dasa deposit. And currently in our feasibility study, we're using a cutoff grade of about 2,000, a little bit more than 2,000 ppm. But you see here, as you go down, scrolling down through the cutoffs at 2,500 ppm cutoff, you can see well over 100 million pounds of, let's say, 0.7 grade. That's a 0.7% at 7,800 ppm. And as you move the cutoffs, of course, you increase the grade. So what we did is we decided to do effectively a high grade mine starting at the flank zone, which is an area where we actually discovered the deposit as it came to surface in that location. And the drilling that was done there to define this was funded all from cash flow coming from our Turkish operation. So in our 2020 PEA, we defined that project with an average grade of 5,396 ppm over a 12-year period, producing 44 million pounds. That project costing just over 200 million. That includes the mine and the mill. So this is a standalone operation with an all-in sustaining cost of $18.39 a pound, which is one of the lowest cost producers in the world based on these numbers. So just that flank zone alone gave us an NPV8 of 210 million after tax and an IRR of 26.6%. Now that again, I remind you that was all done at $35 a pound. So it's quite a bit less than most people are using these days with their numbers calculations. And we felt that, we would do the numbers based on effectively the current market price of uranium to see if this project made sense at these levels. As part of that whole process, we did sensitivities, and you can see here at $35 a pound, our base case, but then moving up to $50 a pound and down to $25 a pound. So really, this project is economic today at today's prices. By the time we get into production at the end of 2024, early 2025 to start shipping yellowcake, we feel the price is going to be significantly higher than $35 a pound. But given the history of uranium pricing, you don't know for sure. So we wanted to make sure that this project would be robust at a current price or even lower, so that we could move ahead with a project. This is the basically a simple bar graph showing how we would ramp up our production in 2024, starting and then moving through excuse me, phase one, and then running into phase two, basically a smooth transition right from phase one to phase two. So a little bit of a history on our milestones. So we entered Niger in 2005. They were just opening up the country to new foreign investment. And so we were in there as one of the first foreign companies, aside from the French that were in the country already. And we signed our mining agreements in 2007. And we started working on areas that we've defined as Tinigaran, Isikanen, and Daji. Those are three other deposits that we've outlined in the country. But then in 2010, we discovered the Dasa deposit. This was with our own teams going through the desert with their scintillometers, and we found a blowout on surface. We brought material back to Canada, and it was running at 30% uranium. So this is something really not seen in Africa in many decades, and we can basically say that this was looking like something that you'd find in Canada in the Athabasca Basin. So we focused most of our efforts there. We were able to raise money in 2011, just at the time of Fukushima, with big players like JP Morgan, Macquarie's, Investec. We were a private company at that time, and we raised money at $2.25 a share. And we were able to use that money, a total of $25.5 million, to move this project forward. And we've done about 160,000 meters of drilling at Dasa since its discovery. So this is a well-defined deposit. We, as I mentioned, did a PEA in 2018. We did another one in 2020, and that's moved us really to the point we are now of completing the final feasibility study. So I mentioned 2011, 2012, and 2017, we did a couple of important milestones. One was signing an MOU with Orano Mining, because we felt with their milling facilities located just up the road from us, about 80 to 100 kilometers, that it might make sense to have some means or some ability to ship ore to Orano to get the project started and to augment their supply. Since their mines were running for the last 50 years, thereabouts, there was some discussion about augmenting their ore supply to extend the life of those operations. So it was a win-win situation, I believe, for Global Atomic and Orano, and we'll talk a little bit more about that as we go. We also did a merger with another company we started called Silvermet, which controlled the Turkish zinc operation, and effectively gave all the global shareholders liquidity, but also gave us, very importantly, cash flow from the Turkish operation, because uranium still was not moving. It was very difficult to raise money for uranium projects. We didn't want to slow down the pace. We wanted to keep things going. So we decided, that's the best way for all the shareholders. I founded both those companies. Most of the shareholders on both sides were the same. So we all agreed at the time that that was a good thing to do. And I think it's worked out very well for us. So in 2018, as a result of that, we discovered the high-grade flank zone and published the initial PEA, as I mentioned. And then in 2020, we published the new PEA focused solely on flank zone area. And we did a lot of other work relating to permitting the project, which was filing our EIS, hydrogeology, geotechnical, and basically our development plan for the project. So at the end of 2020, we received our mining permit, which is a very important milestone, of course. And in early 2021, we received our environmental compliance certificate. So I think where we differentiate from other companies, on top of being a positive cash flow company, we also are fully permitted for our uranium project. So this is now moving after feasibility with an aggressive timeline to actually start working on the site in Q1 next year to start developing the ramp. In addition, in 2021, we signed a marketing agreement with FuelLink. They're our agent effectively to open the doors to utilities that are interested in buying uranium from Global Atomic and having another source of supply. Currently, of course, most utilities are buying from the three big players, being Orano, Cameco, and Kazatomprom. A new entrant in the market like Global Atomic that's got a very good project they're very interested in, and a lot of these utilities like to support new development. So we're finding that in all of our discussions. We also engaged HCF International Advisors out of London, and HCF are very well versed in African project financing, and they were brought in to help us on putting a debt package together. We want to keep dilution of our shares to a minimum. And of course, I think with the economics around this project, we will be able to secure a very favorable debt package and keep the costs down. Okay. So in 2021, we've been advancing our feasibility study. We've done a lot of work in the field. We've completed water boreholes, water pump tests of various aquifers in the area. One of the big questions people ask is, do you have water there? Well, since we're in the lee of the Ayer Mountains, we get a lot of water in the basin. And these are running through aquifers, and they of course supply the towns of Agadez and Arlit, and also the Orano operations. So we've been very successful in completing a hydrogeological study of the area and mapping these aquifers, and there won't be any issues with water at site. We've also run a 6-month pilot plant, taking ore from the first 5 years of mining that we recovered in boreholes at the flank zone, shipping it to Canada, running it at Process Research ORTEC. We've come up with a very good flow sheet. We've increased our recoveries from 92% that we had indicated in the PEA to about 94%. And of course, reduced also some of the input costs, which includes acid, etc. So that pilot program has been very successful and allowed us to optimize and finalize our flow sheet for the final design of our plant. So currently, we're completing all of the quotations basically for bits and pieces that build the plant. We were also doing our underground mine plan, including stope sizing, optimum excavation size, etc. We've done a lot of trade-off studies, including backfill design, mining method, and tailings storage. So right now, as I mentioned, we're getting the cost quotations for equipment and materials, and we're designing our box cut and mine portal. So this is all underway. Geotechnical drilling, we're still doing a bit of that currently, and that may impact the mine design slightly, but we think that we have enough data in here now that the mine design is fairly well cast in stone. So in 2021, of course, some of the catalysts we have is to complete our feasibility study at the end of September. We are, as I mentioned, talking to utilities about offtakes. We're commencing a 15,000-meter drill program currently, actually starting September 1, so in a couple of weeks. So what it'll do initially is drill around the flank zone area on strike to effectively try to push that envelope out a little bit on strike so that we could increase that phase 1 mine plan from 12 years out, potentially longer than 12 years. The other more important thing, I believe, is to move the resource on the other 80% of the deposit from indicated and inferred resources to measured and indicated. So that way we can tie a feasibility around that and include that in our overall numbers, because right now what you're seeing is only, of course, relating to the flank zone. There's still 80% of the deposit that is not included in any economics at this point. So we feel this is a long life asset, and we need to show the market what the total potential is here. So in 2022, we expect to complete our project financing and break ground to develop the underground mine. And as our discussions with Orano are progressing, we expect that we'll conclude some sort of an arrangement with them so that we can actually kick off the mining operation with some direct shipping ore up to Somer, and allow us to develop the mine prior to the bank financing being completed and actually breaking ground to build the plant. We expect that to happen later in 2022, early 2023, when we would actually start plant construction so that it's available to be commissioned in 2024 and commence commercial production, as you see in this timeline. Little bit on Niger, currently the fifth largest global uranium producer. They've been producing uranium there for 50 years at the Orano operations. And they sell to the United States, to France. France was getting about 30% of their uranium requirement from Niger. All the infrastructure is there, including roads, power, water, and the great thing from our point of view, too, in recent months is that Cominac actually shut down at the end of March. So we have a fully trained workforce willing to move to DASA effectively when we're ready to go, that are totally familiar with underground mining. The Cominac operation was a ramp access underground mine, similar to what we've designed for DASA. The Somer is an open pit mine. So we have the trained workforce ready to go and effectively mining the same way as that we would be mining at DASA. This is a little picture of Niamey, a part of it, with the Niger River there on the right, and you can see the Mines Ministry building on the left. So good place to work, very enthusiastic workforce and government. And they're really excited about this new project coming on because uranium, of course, is one of their big foreign exchange generators. This is a shot of our DASA camp during the exploration phase. Now that's probably doubled or tripled in size now because we've been adding more capability, and more people are coming, doing all sorts of different jobs, and of course the drilling starting in September. So this camp is in full swing. We wanted to talk a little bit on this slide about our ESG. So we are big proponents of ESG. Always we feel that mining projects bring a lot of benefits to the host country, and Global Atomic is no different. So since we've been there since 2005, we've done many things in country, including supplying food during drought periods, drilling water wells for local villages, medical supplies, etc. We feel that this project is going to be very beneficial to the region, and a number of small villages in a, let's say, 100-kilometer radius of the mine are going to see a lot of benefits. We're also initiating programs for agricultural development, both to feed people at the mine, but also to provide jobs for local people that will have a benefit from us drilling water wells and then irrigating areas that they could grow food for themselves and to sell to DASA. So the other point I'd like to mention is, of course, we plan on having a green operation. So the plan is to have electric equipment on site backed up with some solar. We are on the grid there. We have a plant located south of us that provides power to Agadez, Arlit, and to the Orano operations. So we would be probably expecting to buy power from them, but also augment it with some solar installations. I'll give you a little bit of a rundown on our zinc operation. So this is our new plant that we built in Iskenderun, Turkey in 2019. This has been a tremendous project since we started it in 2009 at the height of the financial crisis. We established ourselves in Iskenderun. We picked up a shut down old plant that had been used as a dump by steel mills. And we cleaned it up, put it back into operation. It's been making money ever since. We brought in a group, largest in the world, Befesa Zinc, out of Spain, because running a kiln like this was not our primary business. We were actually in Turkey doing primary exploration for zinc deposits, and we didn't want to leave empty-handed during the financial crisis, so we bought that shutdown operation and turned it around and started making money. So in 2019, the partners decided, why don't we knock down the old plant and build a new one? So that's what we did. So this is probably the world's most modern EAFD recycling plant right now in operation. It's very clean, very efficient. We get much better recoveries. We feel this is going to be a very long life asset that can provide revenue to Global Atomic and hopefully dividends to our shareholders in the coming years. So we process electric arc furnace dust, which is a waste material produced by electric arc steel mills. So they basically run on scrap steel that they get primarily from Europe. It contains 25 to 30% zinc, and we produce a 70% zinc oxide concentrate. We put it into containers right at our own port facility. We've got 8 steel mills right on that port as well as ourselves. We're in the center of it. And we ship that to Europe. So our big customers are Glencore, Trafigura, Nearstar. We get paid in US dollars. We repatriate enough capital for working capital into Turkey, but it's a very profitable long life operation. I won't read through all of these points, but suffice to say that we've bumped our production capability from the old plant of about 60 to 65,000 tons of throughput annually to 110,000 tons annually. And we expect this year to be running at about 70% capacity just because of COVID, and steel industry hasn't really recovered yet. But eventually, I believe that the steel industry will come back stronger as things turn around worldwide, and we should be running at capacity, which would be then a very profitable or more profitable operation. So the way it works in Turkey is that we get management fees and sales commissions every month. So that goes to support overheads here at Global Atomic. And then once a year, we get a dividend, which would be an accumulation of cash from the year's operations. And that's the dividend is declared at the AGM. And then it's paid out to the two joint venture shareholders, which should be Befesa and Global Atomic. So we expect this year, and what we've been doing since it started up at the end of 2019 is repaying all of the debt relating to that project. So the Befesa and ourselves put together a loan agreement, and Befesa put in some money on top of cash that we had on the balance sheet that was funding this new plant. And so that loan will be paid out, expected to be, if zinc prices remain where they are, it'll be paid out this year. And then next year's run will be totally accumulated to pay out to Global Atomic that could help fund the DASA project. little bit on uranium demand, and I believe this is from Red Cloud as of April, but you can see the uncovered demand is really starting to ramp up in 2025. That's just when we are entering production with our DASA project. And as you see moving forward, you get into quite a deficit by 2035. So as David Talbot mentioned, there hasn't been a lot of money put into uranium exploration over the last 10 years. And you know, the projects that are out there. There's some tremendous deposits in Canada. They still have to be permitted. And I think we are probably one of the only ones. There might be one or two others that have permits that are ready to go once uranium prices start moving higher. Just wanted to mention a few things, or maybe Bob, why don't you talk about because you put these graphs together. It might be a good opportunity to just explain what we've done here on the next two slides, if that's okay with you.
Absolutely.
I can have a drink of water.
Yeah, the peer information provided here was courtesy of Red Cloud. What you're noticing there, this is a enterprise value per pound of uranium in the ground. And what I've done for the global atomic bar that you see there, part of it is red. It represents a valuation of our zinc business. What I used for that is looking at what Bethesda's valuation is in the market, being a pure zinc recycler business than we are. And what is their valuation? Well, they're trading at about 13 times their EBITDA. So I took a little more conservative view and looked at it from a 10 times EBITDA, and I've updated this just recently based on our Q2 results, based on the EBITDA that we earned to that, doubled it so we could look at an annualized number, did 10 times that, and that's what their valuation is. So you can see the remainder is how our uranium business is valued right now at current prices. This price was as of August 12th, so fairly current. And you can see if you take our blue bar compared to the other blue bars, other companies are getting much higher multiples, and which is odd because, as Stephen just mentioned, we are one of the few that are permitted. We're very near to completing our feasibility study and breaking ground early next year to get into production quickly, and a lot of these other companies are not nearly as close to production. And so we believe on a comparative basis versus this group, we are undervalued. If you go to the next slide, it's very similar. Some people prefer to look at it on a market cap per resource, which, you know, market cap is part of the enterprise value calculation, but it's another way of looking at it, and you see a very similar analysis. That again, our blue bar, our valuation from the uranium is undervalued compared to a lot of this group. And this group that I picked very specifically, these are all developers, all the ones in Africa and of similar size, a few North American ones mixed in the mix there that are in the development stage, beyond exploration. So it's a fairly apropos peer group to look at the company. This particular slide was done a little while ago, but it's interesting. Each bar on this slide represents one of the projects in the works in terms of where their cost structure is, and the gold horizontal line there is roughly where uranium prices are today. So you can see the vast majority of projects cannot make money at today's price. It's the spot price is below their costs. And so we're the third bar from the left. So you can see we're well below that spot price in terms of our cost structure. And everything to the left of that orange vertical bar is in the money today, and those on the other side of it are still waiting for a higher uranium price before they can they make money. Whether they're permitted or not doesn't matter. They're not profitable at today's price. And maybe you want to talk to this slide again, Stephen.
Okay, thanks, Bob. So really, ladies and gentlemen, we've managed to keep a tight share structure with management and board owning about 25%, institutional investors about 25%, and about 50% retail investors. You know, our share price has fluctuated a little bit here in August. We did hit a high of about 334, I think, when things were looking exciting out there in June, July, and then things backed off in the summer, which is typically expected. We find that the utilities have sort of gone on holidays and nobody's really expected to do much until the fall. So that's really our current market cap. Our share price today, I think, is around 250. But you can see that we've really outperformed a lot of the other uranium junior developers, and we've had a pretty good run. And I think our 52-week low was about 60 cents, and the high was about 334. So I think people are recognizing the value of DASA. But I think one thing I must mention is based on our zinc operation, and where Befesa trades currently around 70 euros, our zinc operation alone is worth about 200 million. So really, as we're showing on a 250 million pound deposit, we're trading for about $1 a pound in the ground, which is, to me, very low. And for a fully permitted high-grade project, we think that there's a lot of room to move here, particularly as we knock down a number of other milestones, which will be happening over the next few months. So ladies and gentlemen, just a little bit on our board and management. We've got an excellent team at the company, including some very high-profile, well-known names in the mining business. And I won't read through everybody's CVs here, but you can see from the logos at the bottom, these are people that were involved in all of these companies, including Befesa and Barry Dolbear, Denison, Dow, Falconbridge, Noranda, Sherritt, and similarly with our management team, a lot of excellent uranium people, including in-country Ibrahim Aliso, and Fergus Kerr used to be the general manager at Denison's operations in Elliott Lake. Peter Wollenberg was a director of exploration and resource development for Areva, now Orano in Canada, credited with a big discovery in Northwest Territories. So we've recently added to the team. Pierre Hardouin just joined us from, he was the CFO at Orano in Saskatchewan. And we've had others like Jacques Tremblay, who's a mining engineer based in West Africa, and Ian Moffat, also a real veteran with Global Atomic. He's the one that set up our original camp when we were working on discovering and delineating the DASA deposit. So the people that have been with us have stuck with us. Ron Hallis is our COO. And he was recently at Kinross developing the Tasiast project. And of course, Bob Tate, a very experienced IR gentleman that's on the call with me today. George Flack and I, of course, go back a long way. We started working together in West Africa in 1985 on the Bogasu project in Ghana. And we've been associated for many years. And George has been instrumental in the discovery and delineation of the DASA deposit. He's got a lot of big gold project discoveries to his credit. And I have to mention also Christophe Din, who is a Burkinabe resident and has been our exploration manager at DASA, has done a tremendous job. Rain Lahari, Tim Campbell, sorry if I forgot anybody here, but we'll move along and everybody can read this at their leisure. So just our investment case for everyone on the call. We are the largest, highest grade uranium discovery in Africa, not Niger, in the last 50 years. So this is a very important discovery. It's a very important project. We are fully permitted. We have established cash flow from our zinc operation in Turkey, tight share structure, strong support of shareholders, and we are definitely going to be a significant contributor to the net zero economy. And thank you very much for your attention and participation today.
Great.
David, over to you.
Thank you very much, Stephen and Bob. Great presentation. So now we're going to kick off the Q&A portion of the webinar. Reminder to everybody on the line that you can type your questions into the text box. And we already have quite a few questions. So let's kick it off on the uranium side, guys. Could you please elaborate a little bit on Niger? Do you have any concerns about the recent Western Niger unrest?
Thank you. It's a good question. And we are asked a lot about security. We've been in Niger since 2005. We've had no issues. Where we are located in the Timor-Soy Basin is 1,000 kilometers from the borders. Most of the activity recently with terrorist activities has been along the Nigeria border in the south, and also the tri-border area between Mali, Burkina Faso, and Niger in the southwest. We also have the U.S.'s largest military base just south of us in Agadez, and we have a French military base in Arlit. So the government of Niger views the Timor-Soy Basin as a very strategic region. These uranium mines are very strategic to the government, and they've made a huge commitment to making sure that the area is well patrolled. And of course, we also have our own security detail, as we are effectively mandated by the government to have a platoon of Niger military at our site 24 hours a day. So we are in a very good position from a geographical point of view, being away from where these hostilities are, and a very supportive government that makes sure that there's good security in the region.
Okay, and I guess along the same vein, when you're talking to potential lenders, are they concerned about the political risk in the country?
Political risk, I'd say, is very low. The government just had an election. There's been a new president elected recently in the last few months, and it's very stable. They're aligned with the West. They really are a very supportive government, and we don't have any issues with political stability.
Okay, thanks, Steve. And has the Niger government indicated whether they will be increasing their ownership of the DASA deposit?
That's also a good question. So we are just waiting on that right now. So just so everybody knows, in West Africa, when you develop a new mine, you create a new mining company. The government typically gets a 10% carried interest in the shares of that company. In Niger, they have the ability to fund their pro rata share and earn up to 40% by funding their share. Now, that can be a positive and a negative. So from our point of view, we feel at this point that they are going to remain with their 10% share. If they do want to fund more, then of course that requires us to fund less. So we'll see. They have not indicated yet, but we expect something to be coming out from the government in the next few weeks.
Okay, and if they wanted to fund more, really, it's just they would fund more of the feasibility study capex, initial capex, right? They wouldn't have
No, no. They
Oh.
would actually fund operating costs and capital costs both for the DASA operation. So if it's a $200 million project, they'd have to come up with their pro rata share of that funding, as well as ongoing capital.
Great. Great. Okay. We have a few questions here on the Orano toll milling. Can you maybe shed some light on ongoing discussions with Orano regarding your toll milling agreement for processing at the nearby mill? Maybe what kind of cash flow might you expect in the short term?
Okay, so the whole idea behind our 2017 MOU was that we could have we call it a value opportunity to actually move development ore to Orano while the mine is being developed, and rather than having it just stockpiled on surface. So that's how we've progressed. Now the MOU we signed was for 500,000 tons, so 500,000 tons at a minimum grade of 1,000 ppm over a 5-year period, so 100,000 tons a year. So right now, what's happened in the recent 2 months is that they have taken more ore from DASA, from again drill holes, and tested it in their plant. They've tested both it metallurgically and also blending characteristics with their Sommer ore. So those tests have all come back positive. And so we're now on to the next step, is whether we put together a direct ore purchase agreement or a toll milling agreement. So we don't have the numbers nailed down yet. That's something that will probably be done after people return from holidays. So as soon as we have an indication of what our, let's say, our shipment levels and our cost structure is going to be in our profit margin, we will be releasing that to the public.
Mm-hmm. Okay. And the question was, somebody is asking, the minimum grade to ship to Orano was 1,000 ppm, you said.
That was the minimum that we had in our MOU, but we will be significantly higher than that, of course.
Okay. Now, do you consider that a really a value-added deal? Why not take a little bit more debt and keep those pounds for yourself?
Well, it all depends on the financial markets. So, you know, if people are interested in funding the project now with HCF, we've identified a short list of groups that are interested in funding the project. Depending on the debt equity ratio, you know, if they want a 50-50 debt equity ratio, that means we have to somehow come up with equity, quasi-equity, whatever, maybe cash coming from Turkey to support a debt component, whatever the structure may be. We have to get down to those kinds of negotiations and discussions. You know, clearly, if we can get cash from ore sales quicker, sooner rather than later, then it's going to make a couple of improvements. It's going to, first of all, de-risk the mine. It'll open up the ore body. Bankers will probably want to have a look at it. They're going to say, yes, this looks fantastic. We're willing to do an 80-20 debt equity ratio. So, you know, these things all come in sequence, and we have to get them done step by step.
Sure, sure. And you mentioned during your talk that the project is economic today at $32 a pound. The study was done at $35 a pound, I believe. You know, if spot price doesn't change in the next year, does this change your investment decision to move forward?
No. I think the idea is to move forward on schedule, because by 2025, when you're actually producing uranium, we don't expect uranium prices to be at $32.
Mm-hmm. Yeah. Plus, you signed a marketing agreement here as you approach production. So, are there any uranium prices you accept for contracts? And then for as far as customers go, are you targeting any specific customer base geographically?
Well, right now our big focus has been with the U.S. utilities. We are also speaking to Japanese, Europeans, and so we're trying to effectively introduce Global Atomic to all of the utilities around the world. And, as you said, David, with 445 reactors currently producing power, various groups are going to need fuel supplies, and we feel that, we should make introductions to most utilities, and we are doing that in a systematic way and doing that. So, but right now there's a lot of interest from U.S. utilities.
Okay. And what sort of project financing mix are you considering? How much debt is realistic, and would you consider selling even more uranium forward to help reduce capex requirements?
You know what? We haven't really narrowed that down yet. We've got some parameters that we've been talking with our advisors on as far as debt equity ratios, but it's too early to say until everybody sees the feasibility study, sees how profitable it's going to be, and then we'll figure out those kinds of numbers. So I really can't say at this point in time.
Okay, fair enough. Talking about your PEA, it suggests you're going to use 5,400 ppm uranium, which is actually incredibly high grade for outside of the Athabasca Basin. Do you think this is overkill? Do you think you can lower the mine cutoff and produce more uranium and still be successful?
I believe so, yes. The reason we picked that's actually an average grade of the flank zone. There are areas that are running at even higher grades, but that's an average grade over that 12 years. And, we felt that at 1,000 tons per day, we really worked it backwards from amount of uranium produced. So we felt as a new entrant to the market, an optimum size would be from 4 to 5 million pounds a year. We didn't want to come out with a project that was doing 8 to 10 million pounds a year. Then, of course, everybody'd say, well, how are they going to sell that? So we felt the 4 to 5 million pound a year project sort of put us in a mid-range. It kept the capex down, operating costs down. At 1,000 tons per day at that grade, you're making 4 to 5 million pounds a year. So that's the way we worked it. Clearly, the deposit is very robust, and if uranium, spiked up to where it was in the earlier years, I guess 2010, 2011, around $60 a pound, we could produce more tons. We're designing a ramp that's 5 meters by 5 meters. That'd be the development size. You can run 40-ton trucks on that kind of a development. And, if you wanted to produce 1,500 tons a day and reduce your cutoff grade and produce something at 4,000 ppm, you could probably produce more pounds and continue both shipping to Orano and running your mill at capacity.
Mm-hmm. Okay, so what are some of the ways you think you can further optimize phase one, or even move up phase two expansion?
Well, phase two, we need to finish the drill program, so we will do that. Then we'll get a new MRE done, mineral resource estimate, and put the mine plan on that. Do a PEA effectively on the rest of the deposit, and come out with some economics on it. Mm-hmm. So this will be something that'll be done over the period of time that you're running and producing out of the flank zone. You'll be developing the rest of the deposit.
Okay, and this exploration, you're talking about 15,000 meters of drilling coming September. What's your budget on that?
All in, it's about $200 a meter. That would include drilling, assaying, all of that. So what's that? between $2 and $3 million.
Okay. Sounds good. Let's change gears here a little bit. Do you believe that the Turkish steel industry can pick up enough to provide enough dust for you guys to fill the recycling plant, or do you think you'll be able to look outside of Turkey for additional feed?
Both of those, actually. So we have now applied to the government to bring feed in from outside of Turkey. I think the local Turkish steel mills would like to keep a bit of a captive market, but we would like to import dust as well, just to make sure we have enough. I think that the Turkish steel industry is definitely capable of producing enough EAFD to fill our plant. As a matter of fact, there's a new plant that's just being commissioned this fall in Iskenderen. That one plant alone can fill 50% of our plant. So we feel that once that guy's online, we should be running at much higher capacities.
Okay. And do you ever see yourself separating out the uranium and zinc assets into separate companies like they've been in the past? And one viewer even asked if you'd be interested in or consider selling the zinc plant outright to pay for the uranium project.
Both good questions. We've talked about it a lot, and our partner Befesa would consider buying us out, and based on where they're trading and what this thing is worth, probably selling that asset would finance DASA completely. But right now it provides a valuable source of cash flow, and we feel that it's good to keep it as part of the company at the moment. If we decide not to sell it, I think at some point it might be good to spin it out into a newco that would be dividended to our shareholders, or provide some sort of an annuity to shareholders that own that piece of paper, like a royalty company. So we're a non-operated partner now. We farmed out 51% to Befesa. They're experts in this business. They're a fantastic operator. We have a very good relationship with them. And so this is something you could go either way, either spin it out to our shareholders as a newco or sell it. But at this point in time, we don't want to sell it.
Okay. No, thank you for that. Would you consider uplisting to the New York Stock Exchange or NASDAQ to allow better access for institutional investors in the US?
We would definitely consider that. Right now, we're trading on the OTCQX, which allows us to trade in about 46 states. It's been great for us. We trade a fair amount of liquidity on the OTCQX. But moving to NASDAQ or NYSE, I think it would be good to do that post-production at DASA, because you get into a whole new regulatory environment with Sarbanes-Oxley and a lot of additional costs. So right now we're watching our expenditures. We think we are well served by the Toronto Stock Exchange and the OTCQX. There's been a push too to get us listed on the London Stock Exchange. Being an African project, there's a lot of demand in London for a new uranium story. But currently we've decided just to stay where we are on the TSX, Big Board, and OTC. Once I think you're in production with a significant cash flow, that would definitely be a way to gain more exposure.
For sure. I recall you had an awful lot of London shareholders when you were a private company. So
that's right.
Okay. Another uranium marketing question here. Can you chat a little bit about utilities? Have they been reaching out more aggressively about contracting since the Sprott Unit Trust has been introduced?
Funny enough, from my information, most of them are still very quiet, waiting to see what happens with the market. I think summertime is, generally speaking, a fairly slow time for the utilities, and they usually get back into the market in the fall. By then, hopefully the Sprott situations had some impact with uranium pricing. but most of them indicated that, you know, in the fall they'd be ready to start talking again and potentially tying up some supply.
Okay. Valuation question here. Why do you feel the global is not valued as high as your peer group? And I think you mentioned during your talk, if the zinc business is worth 200 million, that really leaves $1 a pound for a very large, high grade permitted uranium project.
I think generally speaking, there's been a couple of reasons. One, Global Atomic hasn't really been well known. Bob and I are doing, I think, a good job of trying to get the story out there. We're meeting with new people and, of course, engage with fabulous groups like Red Cloud to get the story out there. But I think, yeah, that's one of the biggest reasons is people don't really know what we've got. And I think you know, we had a big run up once we announced we had our mining permit. So there was a re-rating on the stock due to that. But now I think there needs to be another re-rating once we come out with our final feasibility and we start moving forward with the project.
Okay, so we're up at the top of the hour. I was going to finish with a couple loaded questions. You just answered one. Where do you see your share price heading? And you just said you expect a re-rating. So we'll leave that one at that. I guess the last question here then, do you believe Global Atomic's success this cycle will trump Paladin's success of the last cycle?
Well, that's a crystal ball question, David. Paladin hit $8 a share or thereabouts when it came out with Langer Heinrich back in the last cycle. I think we will be able to trump that one.
Good. Okay. Well, thank you very much, Stephen and Bob from Global Atomic. Thank you, everybody else, for tuning in. A reminder that Red Cloud Securities will be back tomorrow afternoon. Tim is going to sit in for Taylor when he sits down with North Isle Copper and Gold. That's Thursday, August 19th at 2 p.m. Eastern. Hope to see you then. Have a great day, everyone. Thank you.
Thank you, everybody.
Thank you.